Well, greetings and salutations, test takers. This is Dean Tenney, also known as the Series 7 Guru. I'm here with Isaac. Isaac won our weekly coaching call drawing. We do it at the end of every Tuesday, and he's taking his SIE. And we said, well, what would you like to do? And he had a couple of things he would like to ask me about. So I just opened a whiteboard, and we're going to knock out whatever things Isaac has on his Dean to-do list. So what's first on our to-do list, Isaac?
So I wanted to do current yield because I know that's one that you have
Okay, love it.
said
Love it.
that is
Good,
a
good.
big one that was going to come up, and I
Yeah.
wanted to make
So,
sure I got that down solid.
all right. So let's just put that here. Now, I just always like to comment on the types of questions that people get. On the SIE, let's just talk in general. There are three types of questions. There are recognition questions, like, corporate immunities settle T plus one, or excuse me, T plus two. Govies and options settle T plus one. Just stuff you either know, options expire 11:59. Then you get practical application. This is practical application where you got to actually do something. Now, I would tell you, if you can't decide what to do, you should always divide. And if you can't decide what to divide, take the first number divided by the second number. That takes care of 90% of the math. Now, on the SIE, there isn't, I wish there were more math, because as I just said, there's no interpretation of a math question. And then the hardest questions you get are judgment questions where you go, oh man, I don't know. That'd be like economics and what the effect of rising interest rates have on the value of the dollar, that kind of thing. Where you go, oh, maybe two or three of those. So I think of current yield as being what an investment pays me divided by, let's put that in a different color, divided by what it costs me. Okay, so that means we have to first have an investment that pays us something. Now, the formal definition of this, Isaac, would be either the annual interest by the current market value. And, my colloquial version of this is what it pays me divided by what it costs me. And so what we would be interested in is what is, if it's a stock and I'm being asked about current yield, what is the annual dividend? Because that would be what it pays me. And then we would divide that by the current market price. We'll do a couple versions of this. And so that would be the current market price. I'll use CMP of the stock. What other things pay us income?
Bonds.
Yeah, right on, bonds. So in bonds, that would be the annual interest and divided by the current market price of the bond. All right, so let's do a couple versions of we'll do one of each. So current market price of the bond. Well, as I said, I'd be doing you a service to mask every key on your calculator, except the divide key. I'd kind of, in your own mind, want you to kind of think, if I'm not dividing, I'm probably doing the wrong math. Now, there are exceptions to that. Let's say I'm a jerk, and I tell you that Bank of America pays a 21-cent dividend a quarter. So what's the first trick here?
We would have to multiply by 4 to get.
Yeah, because we need to know what the annual dividend is, right? So if Bank of America is paying us 21 cents a quarter, you're right. We would times that by 21. And we find out that the annual, by the way, and I'm not being facetious, I'm terrible at arithmetic and math. So anybody offers me a calculator, I'm saying thank you very much, because it's embarrassing, right? So every once in a while on the YouTube channels, I'll be doing some math and get it wrong, and then by the time everybody's lighting up the comments, I've found it corrected myself. So times 4. So now we're back in business. We find out that Bank of America has an 84-cent annual dividend. And by the way, some investors are into income, some are not. There are stocks that pay dividends, stocks that do not. I would point out, Isaac, that the only two ways you're ever going to make money in an investment is either income stream and or price appreciation. So if the investment has no income stream, the only way you're going to make money is through price appreciation. So in this Bank of America example, we have two ways to make money, right? We have the money we get from the dividends, and then hopefully, the stock goes up too. But let's not count on that. And current yield wouldn't be a part of that. That would be called total return. Here we're just entering current yield. So I'm just punching up the stock price of Bank of America, the current market price. Bank of America. Bank of America is priced at $33.80. Let's put that in a different color. And then your point, the test question is, what is the current yield on Bank of America stock? So now we plug that in. Boom. And we plug this in. And now we will answer the question. We're going to take what it pays us. What it pays us is 84 cents by what it would cost us today, which is 33.80. And when we do that, we get a current yield of 2.5%.
Okay.
By the way, last time I did that, Bank of America was like $25 a share. Woo, current yield was higher. And so, things have been going well at Bank of America. Now I'm just going to check myself because boom. I told you I'm terrible at arithmetic, so I'm just checking that. Yeah, 2.48, 2.5. Right. Any question on how I did that?
No, because
Okay, now our next version.
You had the bank, you had the question, and then
Yeah, so let's just put in test phraseology.
Yeah.
A stock pays a 21-cent quarterly dividend and is priced in the market at 33.80. Stock pays I'm being the jerky version, right, where I give you the quarterly dividend. And is trading at 33.80. What is the current yield?
Okay, and so
right, now let's do a bond. Let's say Bank of America has some bonds out there. And let's say the coupon on the bonds is 6%. So again, first thing we got to be able to do is we got to be able to know what it pays us. And 6% doesn't mean anything. We got to turn that into dollars. So how are we going to turn that into dollars?
We would need to know, do we have a bond at a discount, or do we need
no. That's going to be here.
Okay, that's going to be down there.
I like it. So that's good. That's why we do this. So hopefully we have found something here. So right now we don't need to know to figure out how much that is in annual interest. We don't need to know discount, par, or premium. We are going to need that to do the math at some point. But remember that 6% is really important, is based on par.
Which out of a bond is
1,000, right on. So
preferred stock is 100, bond
right on. So we got to take the 1,000. Bank of America, the issuer, says we don't care who's got the bonds. We're paying 6% based on when the bonds were issued. Right. So that's important. So that means we're going to receive $60 in annual interest. Again, what current yield is what an investment pays us divided by what it costs us. So we first have to figure out the annual interest. Now, again, that's going to be in two semi-annual payments. It has nothing to do with answering this question. But you should know that bonds pay semi-annually. So I would expect Bank of America to send me $30 on January 1st and $30 on July 1st. If I own one of these bonds, I would typically own more than that. Now, that means we're back in business in terms of math, because now we have our annual interest, which is $60. And so now your point, now we do need to know what is the bond priced at. Because remember, we said that current yield is what an investment pays us divided by what it costs us. In stocks, what it pays us is the annual dividend. In bonds, what it pays us is the annual interest by what it costs us. the current market price. So now this would be important to tell you what the price of the bond is. Your point now, Isaac, it is important to know whether the bond's trading in the marketplace at less than par, discount, less than 1,000, par, 1,000, or premium. And by the way, that will have a lot to do with what interest rates have done since this bond was issued.
Yeah,
I'll let you pick.
relationship.
I'll let you. Have interest
well,
rates gone up, or have interest rates gone down since Bank of America issued this bond? Your choice, just pick one.
Let's go with what's actually going on. So we'll say interest rates have gone up.
And that means the price of the bond is going
to be at a discount.
Perfect. That's right on. I joke, I said, if anybody ever asks you about economics, finance, investments, you want to sound smart, you should say it has a lot to do with interest rates. And,
And shut up.
You sound good. They say, what about them? Yeah, they fluctuate. Is that good news or bad news? It depends. So you are correct. This would be trading at a discount in the scenario you laid out. And now, given information, they tell you it's trading at 90. Oh, let's just be really jerky. It's trading at 92 3/8. Oh man, I've been a jerk introducing fractions. So now we have to be able to turn that into a dollar amount, right? So that's 92% of par. I think that part of it's kind of easy. 92% of par, bonds trade as a percentage of par. That is 920. And so now we got to figure out what this 3/8 is. And so the way we do that is we get out our calculator again. And what we're going to do to figure that out is we're going to take 3, divide by 8. So I'm going to take that on my calculator, 3 divide by 8. And then I'm going to times that. I get 0.375. And then I'm going to times that by a bond point. You know what a bond point is? A bond point is 1% of par, or $10.
That I did not know.
All right, so that means when I do that now, I find out that that piece of this equation is 375. Now I'm being a jerk. I'm picking out some harder versions of this, right? So now
I have it harder here than on my, so I'm prepared for it.
Better to be too hard than not enough, right? So
yeah.
Now we're back in business because now we have turned the quote into dollars, and that's what we need to be able to do the math, right? Right. So now we're back in business because, as we said, what we current yield is what an investment pays us divided by what it costs us. So now we're back in business. Whoop. And now we can solve because we have the information we need. Oh, come on, dude. I'll just, okay, you want to be that way to me on this thing? Let me do it this way. Well, okay, so now that we have the price, we plug that in. P.S. If you want a test-taking trick, by the way, this is kind of, more than the SIE, but if you go onto your 7, I know the current yield is going to be higher than 6 when I buy a bond at a discount. So, I could just shop the answer set right now and take anything out of there that's offered to me that isn't more than 6. So it pays me $60. It costs me $923.75. And so I get a current yield of 6.5%. I'm actually getting, but that would make a difference on the test. I'm actually getting, you always round up, the test. You're not going to miss it by decimal points, but it pays me $60. It costs me $923.75. That's 6.49, close enough. 6.49, just so you know, you move the decimal over 2 spots, so that's 6.5%. There'll only be one on the test that approximates your LED display. Right, so whatever approximates your LED display would be the right answer. All right, so there are 2, I think, hellacious versions of a current yield question. The big takeaway is we're doing division. Almost always we're doing division. And the way to remember it is what it pays me divided by what it costs me. What it pays me as a stock is the dividend. What it pays me as bond is interest. It's the annual dividend. If it's a stock, it's the annual interest by what it costs me. And then remember, in the bond, that percentage, that 6% that we use is called the coupon rate, the fixed or stated rate of return, the nominal yield, and it's really important you remember that's based on par. That is not based on whatever the price of the bond is in the secondary market, right? So that's kind of an important consideration of what you're looking at as a bond. All right, so what else? Our coaching calls are 30 minutes. We got a few minutes left. What else would you like to talk about?
So I guess the next one's really not as much math, but I was wondering, like, out of all the rules, because you got, Rule 144, Reg A, Reg D, do you have like any sort of way to, like, ones that you need to actually make sure you've got memorized, or
let's just put them up here. Let's start with saying Reg A is not Bob Marley music. Reg D, and you brought up a rule 144. And then 144, we have Rule 144, and then we have Rule 144A. Yeah, I do have a couple tricks, but not a whole lot of tricks. Let's just go over these. These are all very testable. So if you want to sell brand new securities to the public, what kind of securities?
Unregistered.
Well, be careful. You're jumping ahead. Whoa, slow down. If you want to sell brand new securities to the public, you have to comply with the Prospectus Act, which is called
1933, the Paper and People Act.
There you go. Exactly right. And under 33, there are certain safe harbors available. Safe harbors are a way to do something without getting in trouble. Like my brother, he likes to grow pot. I say, what are the safe harbors to grow pot, Chris? I mean, how many plants are you allowed before you're considered to be, not doing personal use? So whenever you ask an attorney, what are the safe harbors available to me? In this case, I'm asking an attorney, how can I sell unregistered securities under 33? He says, well, Dean, there are certain safe harbors available to you that are known as exempt transactions. And one of those is Reg A. So the SEC says, Dean, did you sell brand new securities to the public without making a registration statement? I say yes, but I used Reg A, neener. Reg A is a safe harbor. Now, the test question about Reg A is how much can I raise using this exemption? I can raise up to $75 million using this exemption. And I can sell this to the public. So they said, Dean, you sold brand new securities to the public and you didn't make a registration statement. I say, yes, I used Reg A. Another one that I can use is I could use Rule 147. Another safe harbors available. So the SEC says, Dean, did you sell brand new securities without making a registration statement? I said, yeah, I did sell unregistered securities to the public, and I didn't make a registration statement. I didn't go in that cooling off period or give people prospectuses. I only offered it on an intrastate basis. This is an intrastate offering of securities. And I only sold it to residents of the state. And that's another one of the safe harbors available to me. So there, what we're talking about is selling brand new securities. Now, the last one is a little different. I say, I did sell unregistered securities, but I did not sell them to the public. I sold them by invitation only. It was a private placement. It was not a public distribution. It was not a public distribution. So Reg D is a private placement, and in a Reg D private placement, very testable. I said, I'm not going to sell it to the public. So I can only sell it to institutional investors, and most importantly for us on the SIE, accredited investors. And you asked, do I have, not by the way, when Are you going on to your 7 after this, Isaac? Where are you going out to after your SIE?
I believe my top off is a 6.
Okay, you're 6, then maybe 63, maybe 65, but I wouldn't get into it. But if you are in good standing with a 65 or a 7, you're an accredited investor, but who cares for test purposes? What we care about, here's our first memory aid device, is 1, 2, 3.
I actually can do those. I
Okay,
remember
you
that.
tell me then. Let's see.
So because I watched your video on this.
Right,
So
now,
one.
hold on. I want to put it in test right actually. So Isaac, I'd like to send you a private placement memorandum, but before I do you have
So $1 million annual net worth, excluding your primary residence.
right on
Do you make $250,000, or is it 200,000?
200?
$200,000 this year, with the expectation of making it next year.
That's correct.
And then if you say no to that, it's $300,000 filing jointly the last 2 years with the expectation of.
Excellent. I don't think on the SI they'll get into this, but there's also 2 versions of this. There's 506B and 506C, where we're going to have up to 35 non-accredited investors if we're not soliciting. And C, we can have solicit, but we can't have non-accredited. I don't think we'll get into the SIE. All right, so the other numbers you should be aware of. Now, again, we have another memory aid device for you on Rule 144. And the memory aid device is 144. If you own unregistered securities, I say, Isaac, where did you get these securities? Because the certificates have these nasty red letters that say stop transfer. There's this nasty legend on the stock certificate. Now, you'll probably go through your whole career and never see a stock certificate, but I assure you they exist. And when you come into my office and you have that, I say, ooh, Isaac, you must have got the stock not in a public marketplace. You must have got this stock directly from the issuer. And this stock you holding is unregistered. And so, Isaac, before first step on how we turn unregistered stock into registered stock is you have to hold it for 6 months.
6 months, yeah.
6 months. Now, if you are a control person, what does that mean in plain English?
If
You're
you're
an
a control
officer, you're a
person,
director, you're a principal stockholder.
Yeah.
Right? Larry Ellison is a principal stockholder in Oracle. He owns 40% of the stock. He's an officer, he's director, he's a principal stockholder. If there ever is a control person, it's him. All the stock he owns in Oracle is called control stock. Doesn't matter whether he got in the public marketplace or not. He's not going to be allowed to call his broker and say, dump 2 billion shares of Oracle at the market, because that would disturb the public marketplace. And boy, if you disturb the public marketplace, there's this dog, and it not only growls, it bites. Who's in charge of making people like Larry not to make sure they don't disturb the public marketplace?
So
FINRA,
SEC,
the SEC.
the big one.
Primary jurisdiction, interpretation, and enforcement of the domestic securities laws of the United States of America.
And they like to be God.
Ooh, they are God. I'm joking. You're right now. They're fighting with Elon.
Yeah.
Elon, listen, there's things you can and can't do in the public marketplace as it relates to Tesla. If it was SpaceX, who cares? That's a privately held business. Do whatever you want. But if it's a publicly held business, then it's a difference. There's a difference about what you can do. All right, so that also with their immediate family members. In my example of Larry Ellison, he has a daughter, Meg, who is making movies in Hollywood called Annapurna Pictures. And his son, David, is making pictures. He has Skydance Studios. And I don't know their family finances, but I would imagine they too have a lot of Oracle stock, and they too are subject to this rule. So our second part of this rule is there are volume limitations under 144. You can sell how much of the stock? So Larry's going to file his form 144. By the way, he never sells, but let's assume he did. He files the form. The form is good for 90 days. He can't file it after fact, no later than concurrently. What can he sell?
Ooh, isn't it 2%?
1. That's our first.
1.
That's why we got a great memory aid device that I think is going to be helpful for you. The 1 in 144 is you can sell up to 1% of the outstanding stock or you tell me. Hint,
For
R4, we got a mnemonic, a memory aid for us. So
yeah, I
what?
did not good my rule 144. For
Or the average of the last 4 weeks trading volume.
okay.
Or the average of the last 4 weeks trading volume, whichever is
Greater.
there. You go. I wish you'd get a little more confidence in your voice. Right, whichever is greater. And then our last 4 is up to 4 times a year. Every 90 days. 144. All right, then we have 144A. And what you need to know about 144A is what is the definition, first test question, of a qualified institutional buyer of securities?
Quib. You always use Fidelity, so Fidelity has like 100.
There you go. It's 100 million. 100 million or more makes you a quib. And if you remember the story, what can quibs do? Test question number 2.
Quibs have the ability to trade in the fourth market.
Well, that's true. That's not what I'm looking for here, but you're absolutely correct.
And they have the ability to buy unregistered securities such as SpaceX.
There you go. I love it. I love it. By the way, if it wasn't SpaceX, you're right. SpaceX is a non-registered securities privately held. But one of the transactions a lot of quibs participate in, very testable, are called pipes.
Public institution or
a private investment in a public equity or public entity. For example, Tesla is a public company. And, if Tesla needs to raise money quickly, they might call T. Rowe Price, a quib, and say, hey, would you like to buy $1 billion of Tesla's unregistered stock? Would you like to make a private investment in public equity? It trades on NASDAQ. And then what they would be able to do is get this unregistered Tesla stock at a discount and then register it and make the difference between what they hope is that price. Now, it doesn't have to be a quib that does a pipe. Mark Cuban went mano-a-mano with the SEC and he won. I thought was great. But the guy who knew he was a shareholder in the public companies called him and said, hey, Mark, we need some more money. And I thought I'd reach out to you because you're one of our existing shareholders. And what I'd like to offer you is the opportunity to do a pipe, to make a private investment in this public equity, this public entity. You already own some of the public stock, so why not some unregistered stock? Anyways, the guy had fumbled that presentation so badly that when Mark hung up, not only did he not participate, he dumped his stock. Man, that guy's an idiot. I didn't realize the CEO is such an idiot. And then what the SEC came after him for was trading on material non-public information. And Mark said that was not, it was material, but it wasn't non-public. It was public. Everybody knew they were doing this pipe. And I never signed a non-disclosure statement. So, but if you're, the SEC guy, sometimes you make your bones by, trying to take down Cuban, right? So, by the way, when he won, he went out the front steps and then he called out everybody, the SEC who came after him, said, what a bunch of idiots. Man, I wouldn't do that.
But hey, when you're a multi-billionaire like Mark Cuban, you can get away with it.
He said, one of the reasons I fought this thing is, first thing, I didn't think I did anything wrong, and I didn't. He said, secondly, a lot of retail investors don't have the resource to push back on these guys, and I did, and so I also did it for the little guy. Give those guys a brush back at the SEC. Like, oh, Rod, Mark, woo, So some of us just will, write the check and be done with it because we don't want to be, taking chances. All right, well, that concludes our coaching call with Isaac. I'm going to kill the recording at this point. Let me just stop that. Boom. Boom.